Hello and welcome to Moneylife. This is Sucheta Dalal. Today I'm going to talk about something different, which is our own responsibility for the investments that we make. So we've been going through this completely crazy lifestyle for the last year. 2020 has been a washout. We're in December. Almost the whole year has gone out thinking about health and the loss of livelihoods. I think it's time to talk about our money, isn't it? Look at the kind of decimation of wealth that has happened in this crazy year. It's rarely discussed. But what I want to talk about today is how much of responsibility do we take for our decisions? The tendency almost universal. And remember, I'm saying this after having spent days and months blaming regulators for poor supervision, lack of accountability. All that is true and is there. This time I'm going to talk about our accountability. So what I've noticed is that the tendency is for everybody to play the victim card. When it's women, they say, we don't understand finance. When it comes to senior citizens, they say, we don't understand money. And honestly, other than technology, I don't see why they should have an excuse for basic mistakes. And then there are the millennials and post-millennials who, amazingly enough, very highly paid, are so easily carried away by spiffy presentations, sophistication, the suit boot, demonstrations and PowerPoints, and they are ready to sink in lakhs of rupees without finding out enough. So let me talk about three things today. One thing that really hurts me and is very tragic is the kind of money that's been lost by people who invested in perpetual bonds. These are really the 81 bonds and 82 bonds. All of you who have ever invested or even read the papers know I'm talking about Yes Bank, where 81 bonds were wiped out. And you know that this is a part of the bailout, and you know that it is the bank itself under the previous management that had hard sold these banks and convinced depositors to move from safe deposits relatively to these bonds, saying that they carry a higher coupon rate which is locked in for 5 years and as safe. Those bonds are just extinguished. The investors are in court along with a couple of mutual funds. We don't know when and where that is going to lead to any kind of verdict and whether it's going to be in their favor. Recently, at the end of November, the Reserve Bank of India, as part of the amalgamation of Lakshmi Vilas Bank with DBS Bank of Singapore, again extinguished 82 bonds. Again, there is an outcry. People have gone to court. There's a case filed at the Madras High Court, which has asked the bank to create a reserve. This is just about 380 crore worth of bonds. But people have lost their livelihood. So I have a letter from someone who says, my family has invested 70 lakhs. My parents are senior citizens. Now, I have a few questions. Who sold these bonds to people? Remember, there is absolutely no liquidity. So the questions that I have to ask is, what is the due diligence that each of these investors did, or did they just believe in an advisor and do whatever he told them? They're very, very valid questions. I'm going to ask them. For instance, did they know that Lakshmi Vilas Bank was loss making and that is why it was going to be sold, and that these bonds can skip dividend when the capital falls below a certain point? And in this case, in October itself, the rating agency CARE had downgraded the bonds. So when that happened, did they wake up? In fact, did they wake up after Yes Bank's 81 bonds were extinguished at all? Did they ask their advisors, is this a worry? What should we do? In fact, the trigger for skipping dividend or even maybe writing off the bonds had already been reached where LVB is concerned. So obviously the bet was RBI will not allow it to happen. There will be an amalgamation and everybody would be saved. But remember, RBI has to first be concerned about depositors, and it took care of them. So no wake-up call, nothing. Now here, the interesting thing is that SEBI regulated advisors have been hard selling 81 bonds. In fact, it didn't stop with Yes Bank and Lakshmi Vilas Bank. We understand why there were no warning signals, because when State Bank of India, biggest bank, most secure, issued these bonds again, they were again being sold as equal to fixed deposits with a higher interest rate. Now, Moneylife was the only one, we've written articles, we'll give you the link, which has pointed out, we protested. We said, you wiped out Yes Bank bonds. The same SBI took that decision. You can't allow your distributors and investors to hard sell this. Now, luckily, the Securities and Exchange Board of India paid attention to it. So SEBI came up with new rules and said these bonds simply cannot be sold to retail investors. It created a ticket size of 1 crore. So transactions and allotment have to be 1 crore, which means that most retail investors, we senior citizens looking at it as our retirement saving kind, will have to pause and think. It's meant for institutional investors, qualified institutional buyers as they call them. So SEBI has protected investors for the future, but it is not questioning advisors who hard sold these bonds in the past, though they may be SEBI registered advisors. So our heart goes out to people who have lost money, but there's really nothing that one can do. The outcome of the court cases, if you ask me, is rather iffy. Now I'm going to come to the second kind of gamble, which is a penny stock gamble. Here again the trigger is Lakshmi Vilas Bank. When RBI announced the amalgamation, it said all existing equity will be wiped out. This too has gone to court. But remember, what is equity investment? It's absolutely risky, right? So when a company is making losses, what do? You have to sell. If you don't sell, you are speculating and gambling on a positive outcome, which may or may not happen. In this case, people were betting on the fact that somebody else will take over, maybe it will get written down a bit, but that the new management may lead to improvement and the share price will go up. It happened in Yes Bank, so people expected it to be repeated again. But what is scandalous in LVB is that even after the Reserve Bank of India announced that the shares were extinguished, they kept hitting the upper circuit. Now, I checked and found that there are operators who absolutely create a huge market and a bubble in these penny stocks at prices from 40 to 60 paisa. There's a huge brokerage. They even pay passbacks. They target non-resident Indians, and they are looking at companies like this which are facing the bankruptcy proceedings or are likely to be taken over. It's pure and simple gambling. Gambling is disallowed in India, so people speculate and gamble on the markets. And they're buying penny stocks, the hope that something positive will happen. Now, a source with first-hand knowledge tells me that somebody he knows was able to whip up volumes of 10 crore in a particular stock at prices of as low as for 60 to 80 paisa. The brokerage was huge. He gave a 20 paisa pass back, targeted non-resident Indians. Now, when the shares are extinguished and the gamble doesn't pay off, some people treat it like a casino and write off their losses and say, okay, we win some and we lose some. Some others try to provoke the media and say it's unfair. I get emails like this. I discovered that the gamble has worked in a big way in Ruchi Soya and Alok Industries. Some say people who are interested in the changeover also betted over here, but it worked. On the other hand, where shares were extinguished, then it's not one or two cases. It was LVB, Bhushan Steel, Electro Steel, Uttam Galva, there are many others. So you gamble and you lose. But if you are a long-term investor, haven't looked at the balance sheet of the company ever, kept holding on to it, and then you complain that you have lost money, I think you have only yourself to blame and need to look inwards a little bit. So now the third, another source of big losses, which is investment in realty. In the last 3 years, the government has promulgated the Real Estate Regulation Act. It has gone a long way in protecting consumers. People who buy real estate, you get the right size of house that you paid for, your money is relatively safe, you have grievance redress. The government has done a lot, and slowly, one by one, state governments also have been implementing it. But what if you decide that I'm not investing in real estate, but I'm going to make a financial investment in a real estate project based on something that's completely unregulated and the promise of puffed up returns? Many are doing it. Okay, so I get a bunch of letters from people who invested in Bengaluru's real estate, promising 24% return in their advertisements, again targeted at young, influential, well-paid, maybe software professionals, engineers and NRIs. What did they do? Went and invested with someone who claimed to crowdsource funds for real estate projects. Is that even legal? They now know it's not. It's not regulated, not under the RERA Act, not under SEBI. When did they discover this? After the company had stopped paying. So you start your due diligence and your homework after the company has stopped paying, when you should have checked the legality before. and then you complain. Exactly the same thing has happened. I've received a dozen emails from people who say they invested in CNC Construction in Mohali on the advice of Karvy Wealth. Now, you know, Karvy Stockbrokers has been declared a defaulter, so there is a problem here. People are writing to me because that's the brokerage issue is something that I've taken up with the regulators. But what do you discover in the real estate investment? It's again a financial investment. They have not bought real estate, which is protected by the RERA Act. They want a SEBI regulated wealth advisor or investment advisor. Now, under the rules, SEBI rules for investment advisors are extremely strict. They are supposed to check all this, but there is no record of SEBI having asked any questions whatsoever. Should it? Yes. Should SEBI be monitoring? Does it have the wherewithal to do it? Yes, it can ask questions to advisors. It can also track real time the manipulation of stocks. Why isn't it happening? We are not going to get into that. Not for this video blog. But it boils down to only one thing, which is A, lack of financial literacy, being too trusting, wanting higher returns without asking questions, and unfortunately doing your due diligence and research and finding out all about the laws only after you've lost money. This is a tragedy. It has to change. People have to become responsible for their money because it has to last a long time. If you like what we said, please share this blog with others, become a subscriber, and look at our warnings because we usually manage to warn people well in advance. Thank you.